It is Sunday, February 1st, 2026. Welcome to the Deep Dive. We have got a massive stack of research papers, op-eds, and a lot of flashing red market data in front of us. And honestly, it is a bit of a mess out there.
It really is.
I mean, if you've been brave enough to check your portfolio this weekend, you are probably seeing a lot of red. But the weird thing isn't just that stocks are down. It's that everything is down.
Everything. Crypto, gold, even bonds are acting strange.
Exactly. It feels like the whole financial dashboard is just wobbling in unison.
Well, it's that classic correlations go to one moment. Usually, when stocks fall, you expect gold or bonds to be your safety net, your hedge.
They're supposed to zig when the market zags.
Right. But today, it feels like the safety net is gone, everything is moving together, and that usually signals a very, very specific kind of panic.
And that brings us to the cause. Because this isn't some sudden earnings crisis, it's not a new war breaking out overnight. This is all a reaction to one man, Kevin Warsh, the potential new chair of the Federal Reserve. And the headlines are just struggling to categorize this guy. I was reading through the source material this morning, and it is whiplash-inducing. Half the articles call him a brutal hawk who's going to crush the economy.
And the other half?
The other half imply he's a political appointee who's just going to bend the knee to the White House and, print money.
It's incredibly confusing. If you're an average investor, you've got these two narratives that are completely contradictory. Is he the Grim Reaper for the market, or is he a puppet?
Exactly. And that is the problem we need to solve today. If I'm looking at my retirement account or my trading app, the question isn't just, who is Kevin Warsh? It's, is this guy a friend or a foe to my wallet?
It's the right question, but the sources suggest that to answer it, we have to stop looking at the day-to-day tickers. We have to look at the machinery.
The machinery.
Warsh seems to represent a complete overhaul of the Fed's operating system. This isn't just a policy shift, it's a philosophical U-turn from the last 15 years of central banking.
Okay, let's pop the hood then. Because the first thing that jumps out is this obsession with labels. Everyone wants to know, is he a hawk or a dove?
Right. Simple binary.
A hawk raises rates, a dove cuts them. But you're telling me Warsh breaks that entire model.
Completely. Asking if Warsh is a hawk or a dove is like asking if a master architect is a hammer guy or a screwdriver guy. It misses the point of what he's trying to build.
So it's not about the direction.
It's not about direction up or down. He's defined by the structure of the market. He thinks the entire way we frame that debate is broken.
Structure versus direction. Okay, unpack that. What does that actually mean for the tools in his hands? The Fed just has that one big lever, right? Interest rates.
Well, they have two main tools, and this is where his philosophy gets really interesting. For decades, we have focused on the interest rate, the price of money.
Sure.
Warsh sees that as a valid tool. Think of it like a thermostat. You turn it up to cool an overheating economy. You turn it down to warm a freezing one. He's fine with that.
Okay, standard stuff. Econ 101.
But then there's the balance sheet. This is the trillions of dollars in assets, bonds, mortgage-backed securities that the Fed has bought. This is QE.
Quantitative easing.
And Warsh views the balance sheet very, very differently. He doesn't see it as a thermostat. He sees it as the foundation of the house. And his core grievance, which he has written about a lot, is that the Fed has been using the foundation to control the temperature.
So they're mixing up the tools.
Precisely. They're using a sledgehammer to hang a picture frame. He believes using the balance sheet to, buy bonds and pump money directly into asset markets, it distorts the very structure of capitalism. It messes up the signals.
So nobody knows what the real price of anything is anymore.
Nobody. So he wants to separate them. Use rates for the economy, sure, but keep the balance sheet out of the way unless the house is actually on fire.
So he's basically saying, I might turn the heat up or down, but I'm done ripping up the floorboards every time it gets a little chilly.
That is a perfect way to visualize it. He wants to stop the structural tinkering.
But that creates a huge perception problem. Because when I look at the timeline in our notes, critics are screaming hypocrite. Under the last administration, Warsh was loud. He criticized spending. He criticized the Fed. He sounded like a mega hawk.
He did. His rhetoric was very sharp.
But now, here we are in 2026, and the rumors suggest he's willing to cut rates. On the surface, that looks like pure political opportunism. I criticize the other guys, but I'll print for my guys. Is that fair?
It's an understandable accusation. Plenty of headlines are running with that today. But if you read his actual commentary, his speeches, the flip-flop narrative doesn't really hold up.
How not?
It's not flip-flopping. It's a consistent application of a specific standard to two very different contexts.
How is cutting rates now consistent with bashing the Fed before? Cutting rates is easy money. He was the hard money guy.
You have to look at what he was actually bashing. Back then, quantitative easing QE had become basically permanent. The Fed was buying government debt to fund deficit spending. He called it fiscal dominance.
The Fed was being the government's ATM.
Exactly. He hated the mechanism, not just the result. He hated that the Fed was becoming a central planner.
Okay, so he hated the balance sheet expansion.
Yeah.
The manipulation.
Right. Now, fast forward to today. Interest rates are objectively high. The real rate is restrictive. It's hurting small businesses. It's hurting housing. So Warsh looks at this and says, I can cut interest rates to let the economy breathe.
Okay.
However, and this is the key everyone is missing, I am going to simultaneously take away the punch bowl of QE.
So there's the trade-off. He's saying, I'll give you lower rates, but I am shrinking the Fed's footprint. I'm not buying your bonds anymore.
That's it. It's a strategy you could call big market, small Fed.
No.
Lower the cost of capital so businesses can run, but stop manipulating asset prices with the balance sheet. So to a critic, it looks like a pivot. To Warsh, it's a correction.
He's saying, I'll take the boot off your neck, but I'm also taking away your crutches.
That is a vivid image, and it's dead on. The patient has to walk on their own.
And that kind of sink-or-swim mentality sounds, well, it sounds a lot like the Austrian School of Economics. You know, Hayek, the End the Fed crowd.
Oh, there is definitely a scent of Hayek in the room when Warsh speaks.
Right. I saw people asking if he's a secret libertarian trying to burn the whole thing down from the inside.
Mm-hmm.
Is he? Is this Ron Paul 2.0?
He's not an arsonist, no. But he absolutely shares DNA with the Austrians. Like Hayek, Warsh believes in the sanctity of price signals.
The idea that price is information.
Exactly. The price of a stock, a bond, a loaf of bread tells you about scarcity and demand. And when the Fed just buys everything, it muddies that information.
It's like fog on the runway. You don't know where the ground is.
That's it. So in that sense, he's very Austrian. But here's the nuance that separates him from someone like Ron Paul. The hardcore libertarians want to abolish the central bank. They think it's evil.
Right, back to gold standard.
Warsh accepts that the central bank exists and should exist.
He just wants it to act differently. He's not trying to blow up the stadium. He just wants to enforce the rules of the game.
He wants to restore the pre-QE orthodoxy. He wants to go back to how the Fed worked before the 2008 financial crisis. He's a classicist, not a revolutionary.
So if you ask the Ron Paul crowd,
Yeah.
they probably have mixed feelings.
They'd probably offer conditional support. They love that he's stopping the Fed from being an ATM for Congress. But they're probably holding their noses at the fact that he still plans to set interest rates at all. For them, Warsh is the best they're going to get.
Okay, let's dig into the mechanics of this big market, small Fed idea.
Yeah.
Because you said something earlier that felt like a riddle. You said he wants to cut rates, which adds money, but shrink the balance sheet, which takes money out.
Mm-hmm.
That sounds like pressing the gas and the brake at the same time. Doesn't that just stall the car?
This is the paradox of liquidity. And honestly, this is the hardest part of the Warsh thesis to grasp, but it's the most important for understanding why the market is freaking out.
Okay.
To get it, you have to realize he sees two different kinds of liquidity.
Two types. I thought money was just money.
Not in his worldview. First, there's Fed-printed liquidity. That's QE. The Fed buying assets. Think of it like injecting sugar or caffeine directly into the bloodstream.
A sugar high.
It gives you energy, asset prices go up, everyone feels good. But it's artificial. It's not sustainable health.
Okay, that makes sense. We've been living on Red Bull for 15 years. What's the second type?
Market-generated liquidity. This is organic. This happens when banks trust each other enough to lend, when businesses invest profits, when price discovery is natural. This is the body producing its own energy.
So Warsh wants to switch the fuel source. He thinks we're addicted to the sugar.
Exactly. He believes the economy has been diabetic for 15 years, living on insulin shots and sugar packets from the Fed. By lowering interest rates, he eases the pressure, makes it easier for blood to flow, but by shrinking the balance sheet, he stops the sugar injections.
He wants to wean the addict off the drug.
He wants liquidity to come from healthy commerce, not a printing press. He believes if you stop the artificial pumping, the natural heart of the market will eventually start beating stronger on its own.
Eventually. Dakin is doing a lot of work in that sense. Because the transition from sugar to kale is usually pretty miserable.
It can be.
And that leads us to the politics. We have a Trump administration. Historically, Trump views the Dow Jones as his personal scoreboard. If Warsh cuts the sugar and the market drops, doesn't that put them on a collision course?
It's definitely an awkward marriage. You have a short-term conflict, for sure. The president wants a boom now. Warsh wants to fix the structural rules, which causes volatility.
Right. Fixing the foundation usually means cracking some drywall. And Trump hates cracked drywall.
So why would he pick him? You have to look at the medium-term game. Warsh provides something the administration desperately needs: institutional credibility.
How does he give them credibility?
Think about the bond market. The people who lend money to America, they're nervous, they're terrified. The administration will just print money to fund tax cuts. If the market trusts Warsh, if they believe he's a serious adult who won't let inflation run wild, it calms them down.
So he's the designated driver.
That is a fantastic analogy. He's a designated driver that lets the fiscal side, the politicians, have more fun at the party without crashing the car. He provides the legitimacy.
So the administration takes some short-term stock market pain for long-term borrowing power.
That's the bet. And it's a risky one.
Well, let's talk about that short-term pain because it's happening right now. Stocks, crypto, gold all down. You called it a fear of lost insurance. What does that mean?
Usually, if people are scared, shouldn't gold be up?
This is the most critical takeaway for anyone listening. What we saw this weekend wasn't a panic about the economy. It was a panic about the removal of the Fed put.
The Fed put. Define that for us. The Fed put is this unwritten contract. It's the market's belief that if stocks drop by, say, 20%, the Federal Reserve will step in and save the day. They'll cut rates, announce a buying program, they'll catch the falling knife.
It's the safety net.
And Warsh is signaling very loudly that the safety net is gone, or at least it's a lot lower than people think. The reason gold, crypto, and stocks all sold off together is investors realizing, wait a minute, if I trip, nobody's going to catch me.
So they're selling everything to raise cash. Cash is the only safe place if there's no net.
They're repricing risk. If you're walking on a tightrope and the net disappears, you walk much, much slower. The market is recalculating the price of every single asset based on a new reality where losses might actually be real.
That sounds terrifying. Is this a crash? Are we looking 2008 again?
The data suggests it's not a crash, it's a tantrum, a repricing event. And knowing Warsh, he likely sees this as a necessary evil, a non-event for economic health, but a huge event for market psychology. The market is just adjusting the difficulty setting from easy to normal.
Normal feels pretty hard when you haven't done it in 15 years.
Withdrawal symptoms are very real. The market is shaking because the drugs are leaving the system.
There's one last cold reality we need to touch on. If the Fed stops buying government debt, if Warsh closes the ATM, who buys it? The U.S. government spends a lot more than it makes. Who pays for that?
That's the trillion-dollar question. And Warsh's answer is incredibly simple. The market pays.
Meaning us, pension funds, foreign countries.
Meaning the government has to sell its debt to real buyers at real market prices. There's no Fed in the middle suppressing the rate. If the government spends too much, investors will demand higher interest rates to hold that debt.
So the interest rate becomes a report card on Congress.
Exactly. Warsh believes the Fed has used monetary policy to hide the true cost of political decisions. He wants to rip that mask off. If politicians want to spend $2 trillion they don't have, fine, but they'll have to pay the real market interest rate to do it.
It sounds like he's forcing fiscal discipline by using the market as a weapon.
He's restoring the feedback loop. He wants politics to take responsibility for fiscal burdens. It is going to be a massive showdown, but he'd argue it's the only way to save the dollar long term.
So let's synthesize this. We started by asking if Warsh is a friend or foe to your portfolio. And what we found is that he's neither. He's not trying to be your friend. He's a structural reformer.
Right. He's taking away the safety net, which is freaking everyone out this weekend.
But this isn't random. It's not chaos.
No, this is behavioral profiling. Warsh acts to set expectations. He dislikes misunderstandings. He is willing to cause short-term pain like this weekend's sell-off if it buys long-term health. He is signaling now so nobody is surprised later.
He is ripping the Band-Aid off while looking you right in the eye.
That is exactly the vibe. Kevin Warsh isn't here to crash the market. He is here to treat the market like an adult. And sometimes being treated like an adult involves paying your own bills.
Which brings us to the final thought for the week. We all say we want a free market. We say we want true capitalism. But looking at the panic on the screens today, are you actually ready to invest in a market that doesn't have a safety net? Are you ready for the real price of things?
It's a question every investor needs to answer for themselves. The training wheels are coming off.
We'll be watching to see if the market learns to ride the bike or falls over. That's it for this deep dive. Thanks for listening.